Good Monday morning, 30 minutes till the start of the cash trade. I'm Matt Miller.
I'm Dani Berger. Bloomberg Open Interest starts right now.
Coming up, the Sell America trade is creeping back on as the Trump administration escalates its attacks on the Fed. Powell pushes back.
CEOs remain on guard as President Trump once again rattles stocks. This time, he is targeting credit card companies.
And on the energy front, the president signals he may exclude Exxon from his plans to rebuild Venezuela's oil industry.
I think we need to talk about whether the Sell America trade is really back on. It's like dollar kind
That's why I said
falls.
creeping. I said creeping back on.
I think that's very fair. It is creeping back on. The trade that is on is sell credit card companies and buy now, pay later. That's a hard thing to say together. Capital One, Citigroup, but also JP Morgan, Visa, MasterCard, American Express, all falling this morning. President Trump said that credit card vendors need to cap interest rates at 10% by January 20th or be in violation of the law. Klarna CEO said, cool, we love that. That is a great idea because credit cards are unfair to low-income people. But the issue is, Matt, is if you cap credit cards, maybe they take on less risk, and then they go to buy now, pay later, and that's likely why they're rallying today.
Right, or eventually what's more likely is simply loan sharks.
That too.
And I need to look one up in Yonkers. Walmart is making gains as it will replace AstraZeneca on the NASDAQ 100 and inked a deal with Alphabet to integrate Google's Gemini. A lot of words there, but the idea is Walmart is getting more and more techie and involved in AI. So this AI company, Dani, is now up 3% in the pre-market.
By the way, a lot of words that would have been meaningless like 5 years ago had you read that out loud. So is the new world. Let's start with our top story, where Fed Chair Jerome Powell released a statement after being served a grand jury subpoena from the Department of Justice. Powell called the move political.
No one, certainly not the chair of the Federal Reserve, is above the law. But this unprecedented action should be seen in the broader context of the administration's threats and ongoing pressure. The threat of criminal charges is a consequence of the Federal Reserve setting interest rates based on our best assessment of what will serve the public, rather than following the preferences of the president.
Joining us now is Michael McKee, Bloomberg's international economics and policy correspondent. I got to say, I feel like this was one of the most bluntly we heard Powell respond to any of the attacks on the Fed.
I think Ian Katz of Capital Alpha Advisors put it well this morning. He said the DOJ action is surprising but not stunning. Powell's response is stunning and surprising because the Fed has kept a very low profile in all of the political disputes with the president up to this point. But I guess they reached a breaking point on Friday when they got the criminal subpoena. Now, this is not an indictment so far. It's just a subpoena for records because they seem to be investigating the idea that Jay Powell did not tell the truth to Congress about renovations to Fed buildings in Washington. Nobody quite knows why this happened because the president is denying any involvement. He told NBC last night, I don't know anything about it, but he's certainly not very good at the Fed and he's not very good at building buildings. So the question is, where do we go from here? We don't know if there's going to be an indictment, and if there's an indictment, whether or not it would ever actually go to trial. They haven't been very good at getting indictments against officials lately. Then Tom Tillis, the Republican senator from North Carolina, says he's not going to vote for anybody until this is all cleared up as the new chair for the Fed. And since there's a 13-11 Republican-Democratic split, one Republican defecting would keep the banking committee from moving anybody forward. Tillis saying that he needs to have some sort of resolution. We don't know what it's going to be. Powell's chairmanship does end in May, but he can stay on as governor. We've talked about that a lot. Maybe he'll do that. If he did, who knows? Maybe he could end up staying on as the chair of the Open Market Committee, which makes interest rate decisions, and that would be completely contrary to what the president wants.
That would be surprising. And I thought Tom Tillis's statement was, well, it could be stunning in the literal sense, right? It could stop everything in its tracks. And you were explaining on surveillance earlier this morning how that could result in Philip Jefferson being chair of the Open Market Committee, or they could pick someone who's not even on the Fed?
Well, Philip Jefferson would become chairman of the Fed because by law, Powell's term ends as chairman. So as vice chair, Jefferson would ascend to that job. But the Open Market Committee, which sets interest rate policy, can elect its own chairman. They have always chosen the chair of the Fed, but they could pick anybody, even someone who is not at the Fed. So I would assume they would kind of rally round the flag and just keep Jay Powell in that job. But this is still a long way down the road. We don't know what's going to happen in the next hour, let alone by the time we get to the end of May.
All right, Michael McKee, we're going to hold you on standby here because things are moving so quickly. Our chief economics and policy correspondent. Credit card companies are in the red this morning after President Trump said lenders are breaking the law if they don't cap interest rates at 10% for 1 year. Joining us with more is Bloomberg consumer finance reporter Paige Smith. And Paige, I want to ask you which law they're breaking because I doubt there is one. But are they going to be cowed into lowering interest rates?
Thank you for having me this morning. I think that we are certainly in a wait and see mode. To speak to your first question, I think it is fair to say that it's unclear exactly which law would be the president would be relying upon to enforce such a statement. But it was certainly causing a lot of flurry over the weekend with credit card companies, sort of scrambling, I would say, to respond to this. And the president came out with this statement late on Friday evening, and bank lobbyists who are, the majority of which are credit card issuers, many of which are credit card issuers, sort of came out with their own response to, and it was sort of more, they struck something of a measured tone, I would say, in response to the president's statement. And then, he doubled down on Air Force One last night. So it's certainly something that is top of mind for the president and something the banks will need to be mindful of ahead of bank earnings this week as well.
Is it a fair assessment? I probably should have asked you this before I said it at the top of the show, because you know this better than anyone, certainly better than me. But if there is a cap, all it means is that the credit card companies can't price risk, so they don't take on that risk. And it means less credit available to less people.
That's at least what analysts are saying at this moment in time. If this is something that is enforced, if it is something that actually comes to be. As of now, all we have are these statements from the president. And back to Matt's question, in terms of how this will actually be enforced is still quite unclear.
All right, Paige, thank you so much for joining us. Something to follow. Bloomberg's Paige Smith. And in other companies that are being job-owned by the president this morning, Exxon, those shares, they are down just about 1%. President Trump said that he might exclude it from work in Venezuela. Bloomberg oil strategist Julian Lee joins us now. Julian, would Exxon really even care about this, considering the very reason the president said that he would exclude them is because Darren Woods called the country uninvestable?
Yeah, I mean, I think President Trump just can't let anybody else have the final word. And if somebody doesn't toe the line and doesn't, really cheerlead everything that he proposes, he's going to come back with something like this. I don't think this is going to make a big difference to Exxon. I mean, as you said, they reckon that Venezuela, as it stands at the moment, is uninvestable. Given their experience in that country, that their assets have been appropriated without compensation, not once but twice, it's difficult to argue with that. I think what the president will say is that he's going to change all this and Venezuela's suddenly going to become wonderful and everybody's going to be protected and everyone's going to get their money back and make huge profits, and Yahoo, ExxonMobil won't share in that.
Julian, I saw Darren Wood's speech, and I thought it was really interesting. He's looking for a win-win-win. He wants shareholders, obviously, to benefit. He wants the government to benefit, and he wants the people, I imagine he meant, of the home country to benefit as well. It doesn't look like that's the setup for any of the oil majors here, really not even Chevron. Are there big integrated oil companies lining up for this opportunity?
I don't think anyone is hammering down the door to make multi-decade investments of tens of billions of dollars to really get in and boost Venezuela's production back to the 3.5 million barrels a day that it was before Chavez came to power. Sure, you'll get companies that will go in, and I'm sure Chevron may well be one of those that will invest relatively small amounts here and there, in Chevron's case, to boost their current production. But I think that to go into these big greenfield developments that won't pay back for decades is a huge ask at the moment, particularly as there hasn't really been any regime change in Venezuela. I mean, this is, apart from the guy at the top, this is still the same people running the country who were running it, 6 months ago. These are the same people who confiscated the assets of foreign investors.
And I suppose you could assume at least some of these people are also working with cartels to get cocaine into Europe. Although I don't know the details of that. Julian Lee, great to have you on. We're focused on the oil market, not the coke. In terms of futures this morning, we're looking at a little bit of a pullback, although we did hit an all-time record high on Friday on the S&P 500 as well as the Dow Jones Industrial Average. Right now you can see S&P futures down just about 0.5%, NASDAQ futures pulling back a little bit more.
Some of the movers that we are looking at this morning, United Health is one of them. They're down just under 1%. There's a report that a Senate committee found it used aggressive tactics to collect payment-boosting diagnoses for its Medicare Advantage members.
Shake Shack preliminary fourth quarter sales were below Wall Street estimates as fast casual chains finish one tough year and kick off another. You can see the shares down 1 1/3%.
By the way, they blamed weather. That's what they said, why people weren't coming in. Too rainy in the Northeast, apparently. Some other retailers out with holiday sales results. Abercrombie, those are tumbling. Wow, down 17.7%. Those results were disappointing, as were Urban Outfitters and Lululemon. Yes, they reported sales that beat expectations, but not by enough. Investors are not impressed.
And we should bring you some breaking news here. Paramount saying that it plans to nominate directors for election to the Warner Brothers board. Paramount says it's perplexed that Warner Brothers didn't respond to its December 4th offer, and it filed suit this morning in a Delaware Chancery Court. So we'll continue to bring you news of Paramount's attempt to take over Warner Brothers Discovery. Right now, Paramount shares are up just marginally in the pre-market. Warner Brothers and Netflix shares are down. Coming up, Walmart is joining the NASDAQ 100 as it becomes an AI company, including its push to get into chatbots. It's got a new deal with Google's Gemini. We'll tell you more about that in this program. This is Bloomberg Open Interest. Let's get now to high interest. Look at what's making headlines around the world. Iran's foreign minister says security forces have full control of the country after 2 weeks of violent unrest. Protests erupted on December 28th after a sudden collapse in the value of the currency. According to the human rights activist news agency, more than 540 people have been killed and over 10,000 have been arrested. Moody's says at least $3 trillion is set to flow into data center-related investments over the next 5 years. According to the report, much of the capital will come directly from big tech companies themselves. Microsoft, Amazon, Alphabet, Oracle, Meta, and CoreWeave are on track to hit $500 billion in data center investments this year. And Meta is appointing former Trump advisor Dina Powell-McCormick to a new senior management role focused on partnering with governments and investors on AI. The former Goldman Sachs executive is set to join the company this week as president and vice chairman. Previously, she served on Meta's board of directors for 8 months before unexpectedly resigning. Dani?
Matt, let's get back to the breaking news you mentioned before the commercial break. Paramount suing for the disclosure of basic information to enable Warner Brothers Discovery shareholders to make more informed decisions. It's a lawsuit. They also plan to nominate directors for the election to the Warner Brothers Discovery board, and a whole lot else. Joining us now is Bloomberg Tech's Caroline Hyde, who's been digging through the headlines just coming out moments ago. I know these are fresh, Caroline, but it does seem more aggressive, the posture that Paramount's taking at this moment?
The hostile takeover is going very hostile.
Yes.
And they're trying to pull out all the strings. And what they're worried about ultimately is that the shareholders aren't going to get the ultimate say. They're trying to once again convince that their unchanged $30 offer is still more tantalizing than that of Netflix's. They're trying to attribute, really, saying that there is a $0 equity value for global networks, and that is the main thesis. If you look into the statement here, they're saying that Warner Brothers has provided increasingly novel reasons for avoiding a transaction with Paramount, but that it has never said, because it cannot, that Netflix transaction is financially superior. But most would say that the fact that Netflix only wants the streaming and the studios, and the fact that there will be some sort of equity value given to investors by spinning off global networks, and that ultimately is better at the moment the shareholders. That is what Warner Brothers Discovery has been trying to convince their shareholders of. But as you say, ever more nuclear it feels that Paramount is going, because the clock is ticking.
I mean, the basics are, we're talking about a $100 billion takeover, right? And
no small fry.
Netflix is a $400 billion company, so it seems digestible. Paramount is worth what? 14 billion, 15 billion max?
But got a very wealthy father of the ultimate CEO.
But not Netflix level wealthy, right? I mean, no one has that much money yet, aside from Elon Musk at some times. So they're stretching themselves, Paramount is, even to make the $30 a share offer, right? How much higher can they actually afford to go?
And I think that's what investors had ultimately come on and said time and time again to us, is that we think they'll come back with a higher sweetened offer. The fact that they haven't thus far, but they've been trying to vindicate how good for the money they are, the fact that there is a revocable, non-revocable now, like basically commitment by the father of David Ellison, who is the CEO of Paramount, saying that I will be there to backstop this deal. You are good for the money with me because I'm one of the most wealthy individuals in the entire world. That is what we're trying to get to the grips with, is how much that stretches Paramount. But ultimately, a lot of investors and analysts out there are saying Paramount needs this deal far more than Netflix does. If it's really going to be able to show the breadth in the catalog that it is and go up and head-to-head against some of these key competitors in the Hollywood space, they need to solidify this Warner Brothers deal. They need the back catalog that WD has more than Netflix does. This is why they're fighting so hard.
Caroline, one of the other stories I know you've been closely tracking is that of Walmart, which at first blush would seem odd. Why would Bloomberg Tech be closely looking at a consumer company? But they made moves today. They're being included in the NASDAQ 100 because they've grown in size. They also have a deal with Alphabet. It feels like this is a company that's trying to be featured on your show more often, Caroline.
And Doug McMillan has been handing that over, hasn't he? As he's saying, farewell, good luck, I've been at this business for more than 30 years. He hands over the CEO role with the clear intention to signal this is a business that's pivoted to tech in such holistic manner that back in December, they decided after 5 decades or so, 3 decades at least, on the New York Stock Exchange, they were going to come onto the NASDAQ because they are a tech company and therefore they're going to be on the NASDAQ 100. That means that, of course, there's automatic purchasing. It drives the shares higher. So that's part of the reaction. But so, too, is this ever-deepening intertwine with the likes of OpenAI. We know they already have a deal with OpenAI, and you can make direct purchases of Walmart stuff when you're in the chatbot. But now it's the Retail Federation event that happened over the course of the weekend. That's why we get the announcement on Sunday that they're also going in with Gemini. Now, already, Gemini, Google, has been helping various retailers build out their own chatbots, be helpful on customer services, but they want those retailers to come in-house onto their chatbot. So you can go on Shopify, that you can go on Walmart and make direct purchases via that chatbot. We actually spoke with the guy leading the entire AI innovation charge over at Walmart while we're in CES. He's just come from Instacart, and they are so all in the artificial intelligence area, and they're really trying to focus and pivot and say, look, we will meet our retailers, we're going to meet our consumers where they're at, and generally that's on a chatbot.
I'm waiting for you. There'll be a day when Caroline and Ed bid for the CEO of International Paper, right?
Yeah.
And that becomes a Bloomberg Tech spotlight.
Surprised it hasn't already.
Caroline Hyde, co-host Bloomberg Tech, that kicks off at 11 a.m. Definitely want to tune in for that because every company in the world is now a tech company. Coming up, Rebecca Patterson joins the show as traders weigh threats to Fed independence. This is Bloomberg Open Interest.
This new threat is not about my testimony last June. It is not about Congress's oversight role. This is about whether the Fed will be able to continue to set interest rates based on evidence, or whether instead monetary policy will be directed by political pressure or intimidation.
Jerome Powell's response to the Justice Department subpoenas. Joining us now is Counsel on Foreign Relations Senior Fellow Rebecca Patterson. Did you have a weekend, Rebecca? Probably not, I'm guessing.
Not so much, no. Lots of reading, lots of analyzing things, yeah.
Unfortunately, that seems to be the way that this year is going. With this, there were these renewed calls of, it's going to create Sell America again. I'm looking at a market response where, sure, U.S. stocks are kind of underperforming. Dollar is weakest in 2 weeks. 30-year yields are the highest in 1 week. Is this a tradable event?
I mean, it is a response, right? And directionally, it makes sense. If there's a greater risk that the Fed loses some measure of independence or is just perceived to be politicized, you would expect that to get reflected in the market. So I think what we've seen today makes sense. But for this to become something more than that, we probably need more of this, which who knows is the unfortunate answer. Yeah. I worry more about not Sell America, but keep hedging the dollar, a dollar weak story, on the ripple effects of Venezuela, honestly, because it's not just Venezuela, it's Cuba, Colombia, Mexico, Canada, Greenland, And if more and more of these countries are questioning their alliances with the United States, how do they think about their exposure to the United States? So I worry more about that as a kind of a slow bleed over the course of the year than the immediate effect of the Fed, although the Fed event is still material.
Claudia Scheinbaum had a conversation. She said a very good talk with President Trump on trade and sovereignty. What's the biggest risk? And we just got about 20 seconds. We're going to come back and keep you here. But what's the biggest risk geopolitically, you think?
Oh, gosh. I mean, boots on the ground in Mexico is unlikely, of course, but so underpriced. And because it's such a critical trade partner for the United States, that's one that is high on my radar screen because it's underpriced. Taiwan's the risk, but everyone knows it's out there.
All right, we're going to keep you, as I said, here with us, Rebecca, through the opening bell. In terms of futures right now, we do have a little bit of a sell-off on our hands, but remember, this comes from all-time highs on the S&P 500 and the Dow Jones Industrial Average. We're back in 2 with the open. We are moments away from the start of trading kickoff the week with us, Bloomberg Open Interest. I'm Matt Miller. We're looking at futures that are down a bit, right? 0.5% on S&P, 0.75% on the NASDAQ. But this is after we hit, at least on the S&P, another all-time high on the Dow Jones Industrial Average as well. We're still a bit away from that on the NASDAQ, but obviously at pretty elevated levels across the board. It was an amazing 2025 after a great 24 and 23. You got a healthcare theme really across the bells. In this one, I don't know if they actually took the bell from the New York Stock Exchange and flew it out to San Francisco, but JP Morgan is holding its annual healthcare conference there, and they're ringing the bell. This will probably be broadcast on screens all over the floor of the New York Stock Exchange. You've got Twin Health ringing the bell at the NASDAQ, which apparently uses some kind of AI digital twin technology for healthcare of some sort. I'm sure I would understand if it were explained to me. Private company.
Right.
There's a lot going on outside of healthcare, but we should expect to get some healthcare headlines because of this conference.
Yeah, I'm excited to see what they are. Katie Greifeld is down at the conference too, and some interesting conversations she's going to bring us. But Matt, it has been a deluge of headlines coming not from industry, but from the president. I'm looking forward to talking with Rebecca Patterson about just the amount and number of company announcements, the fire hose we're getting from this administration in an affordability push. One of them, credit card companies getting hammered here at the open. Capital One down 6.7%, Citigroup down 3%, Visa is down, MasterCard, American Express, because Trump said that they need to cap credit card interest rates at 10% by January 20th or be in violation of the law. It's benefited the likes of Klarna, of Affirm, the buy now, pay later companies. Because if these companies can't take on the risk or can't price risk appropriately, maybe they shut out people from owning a credit card, Matt, and they just have to go to buy now, pay later.
Yeah, this is something we're going to have to touch on with Rebecca Patterson. Sure. Normally, I wonder if anybody has explained economics to the left, but now it seems like the right also doesn't really get it. We'll talk about that. Walmart shares just touched a record high, right now up more than 2% in the cash trade. Walmart will replace AstraZeneca on the NASDAQ 100 next week. It also inked a deal with Alphabet to integrate its one more retailer integrating into AI chatbots, in this case with Google's Gemini. So watch this space. But I want to bring back Counsel on Foreign Relations Senior Fellow Rebecca Patterson. And Rebecca, although President Trump said that affordability was like a hoax, that term made up by Democrats, to hurt Republicans in the midterms, he's now focused on it to the extent that he is going to ban institutional buyers from private homes. He is going to stop private defense companies from buying back shares, issuing dividends, or paying CEOs too much. And now he says he's going to cap interest rates on credit cards at 10% for a year. Does any of this make sense from your study of economics?
It feels like policy folks supporting the president have given him a list of possible things that might help affordability, and they're just throwing it all at the wall.
But he's advised by Republicans, right? Not by Elizabeth Warren. He's not advised by Zohran Mamdani.
I appreciate that. But when you look at the opinion polls, voters, this is the topic, right? If he and the Republicans want to do well at the midterms, they have to address, or at least show that they are actively trying to address, affordability. So buying $200 billion worth of mortgage-backed securities to bring down the mortgage rate, capping credit card, trying to bring down drug prices. I mean, I've started keeping an Excel file so I can follow all these things because there's just so much. Some of them will probably help. Some of them might not help, but they're talking points. Some of them actually work against affordability. Going after Jerome Powell, and I don't want to make it sound completely political, that's a supposition, right? But it's perceived to be. That's pushing the long end up of the Treasury yield curve, right? So that actually lifts mortgage rates. So some things work against each other. The point you just made on credit cards. So we cap the interest payment on credit cards. That helps people who get to keep their credit cards. But for people whose accounts are closed down because their credit isn't good enough, to your point earlier, now they have to go to something even worse with higher interest. So again, there's a lot going on. We're going to hear more at Davos. President Trump said he's going to announce even more on housing. Maybe we get a 50-year mortgage or portable mortgages. Again, we'll have to see what's legal, what needs congressional approval. But right now, let's just throw it all out there and show the American public that we're trying. I'm glad he's trying. It is a real problem, but I'm just not sure some of these things make a lot of sense, including telling companies what they can and can't do.
I just wonder how you approach it as a market participant or even as one of these companies, because the prevailing idea coming out of 2025, and maybe the reason equities did so well even after April 2nd, was that Trump will back out, that the taco trade, whatever. Claudia Sahm was on X basically saying the new trade is MAC, Big Mac, midterms are coming.
Yes.
Is this still a present that you assume, okay, you treat it seriously, but in all likelihood, these things aren't going to get done, so you don't price it in, or if you're a company, you don't change strategy? Or do you say midterms are coming, he is serious, we should be assuming that most of these things happen, if he can make it happen within the law?
I think it is all focused on the midterm. And the irony is that doing everything and anything to try to address affordability and other goals continues this policy uncertainty that actually hurts business investment and hiring. We know that AI was a small piece of the softer job market last year. The bigger issue was uncertainty. I don't know what's coming, so I'm going to go slow on CapEx. Outside of AI, CapEx was very soft last year, capital spending. So if we continue to have uncertainty, especially if it's specific companies being targeted, it goes against the economy. The economy is doing great anyway, right? We're growing at above trend, but we could be doing even better if we just had more certainty and less policy surprises every Saturday morning and Sunday night.
The economy's doing great. We're growing at above trend, even with these massively restrictive rates from the Fed, right? Stephen Myron says he would cut like 150 basis points right now, down to 225.
Oh, your sarcasm is coming at me large today.
Sarcasm is the lowest form of wit. I apologize.
No. I hear you. We don't need a rate cut right now, obviously, right? If you have an unemployment rate at 4.4%, we have core CPI coming out later this week. The consensus, it'll be around 2.7% year on year. That's almost a point above the Fed's target. Of course, we're not going to have rate cuts anytime soon. We shouldn't. We're not restrictive. The mortgage rate that needs to come down to help affordability is as much a function of our fiscal situation as it is the Fed funds, probably more so.
Rebecca, the mortgage rate right now has to be a function also of the DOJ probe into the Fed, right? I mean, if they push hard there,
yes,
the mortgage rate's only going to go up.
That's correct. That's correct. And that's why I think the president and the administration need to be careful. Some of the affordability stuff, buying the mortgage-backed securities, pulled down the mortgage rate almost instantly. But then efforts like this against the Fed basically undo it. So there needs to be more coordination and thoughtfulness around, okay, as an aggregate, what does all this stuff do, right? If we go after Venezuela to get oil prices lower, that's great. But what about Iran and the possibility that oil supply is hurt if Iranian troops go after the Strait of Hormuz? Then oil prices go up. All these things are connected. It's so important to think about the ripple effects from one or another event.
But as part of the reason why we maybe haven't seen a bigger reaction, and definitely your point is right, that we are seeing a reaction. But the fact we're not seeing a bigger reaction is because this economy is good and inflation isn't a problem. Sure, it's above target. But how different would things be if this was a president who's trying to push through rate cuts? If inflation was a problem, can we ignore it just as long as things look benign?
I think the market reaction isn't bigger because overall the economy is still doing well, quite well. We're probably going to have another good earnings season kicking off this week with the banks, which will probably post some really good numbers. We still have fiscal stimulus coming this spring from tax refunds.
The wealth effect is great.
Right. And so when you have a shock, it's more likely to have contagion if an economy is already vulnerable. We're not vulnerable.
I also wonder if what this does is, and this point has been made before, but it basically encourages Powell to stay on. I wonder if he almost becomes the shadow Fed chair, and whoever Trump puts in is almost the lame duck. So if in that way, maybe it's not a curve steepening event because you have Powell still there at the reins saying, hey, I'm kind of running the show behind the scenes.
I think we are going to be having a steep curve all year, but I see your point. Unfortunately, what this does is whoever is named to be the next Fed chair, there will be some perception that that person is not going to act independently, whether he wants to or not. And I'm assuming it's a he at this point, rightly or wrongly. So that person is going to have to overcome that stigma just to prove that he's doing the right thing for the economy. That's kind of a shame.
Rebecca, I wish we had hours to discuss this because we honestly could.
There's so much to discuss.
So much. Please come join us again soon. I'm sure the world will be completely different when you do come join us, in a couple weeks' time. Rebecca, thank you so much. Rebecca Patterson there. Let's get a check on markets this morning. About 10 minutes into your trading day, we are decisively negative. One of the stocks that are doing very well, if you just look in the additive column, it is Walmart, adding a lot of weight to the index, which again is overall down. Walmart up nearly 2%. It gets added to the NASDAQ 100. Jeffrey says that those passive flows will create about $19 billion worth of demand for Walmart shares. The more interesting stuff is what's declining. Apple leading the decline just because of its size, but look at what comes after it. Visa, JP Morgan, MasterCard, Capital One, American Express, Citi is up there too. All of that part of the president's push, as we've been discussing, to cap credit card interest rates at 10%, saying they would be in violation of the law unless they did so by January 20th. When it comes to the sectors, it won't surprise you that financials are at the bottom of the pile, given what those companies are doing. And what poor timing. They're all about to have their earnings calls. We kick things off with JP Morgan tomorrow. How many questions from analysts are going to be, how are you going to handle this? Awkward time to have to talk to the public. Consumer staples, materials, those are at the top. Consumer staples probably because of Walmart shares that we just looked at that are rallying this morning, Matt.
We had to get a popcorn machine, honestly, because this is going to be fascinating to watch. Especially Jamie Dimon, how he wades through this. This one will be really interesting. Hopefully he does a little bit better than Darren Woods, right? On Friday. Coming up, big bank earnings this week, as Dani is pointing out, will shed a light on the health of the U.S. economy, but also entertain us when it comes to the way they deal with the president. Our chief Wall Street correspondent joins us to talk about that next. This is Bloomberg Open Interest.
Take a look at top calls this morning, the analyst action that we are following. First up, Bank of America upgrades Comcast to buy. The analysts there say that they will benefit from a transformative year for For the media and cable industry, those shares are up just under 1%. Transformative it's set to be. Citi upgrading Palantir to a buy, saying that Palantir could see 80% revenue growth this year as AI use cases accelerate. It's hard to imagine AI is not already priced into Palantir, but those shares move up 2%. Finally, KeyBank downgrades CrowdStrike to sector weight, pointing to a measured budget outlook for security in 2026 and a yet-to-be-seen AI tailwinds. Those shares fall 1.7%, Matt.
All right, we get our first major group of earnings in the new year this week. The big banks, starting with JP Morgan tomorrow, will shed light on how they're profiting on the U.S. economy. Executives will also face questions on President Trump's attack against the credit card industry, as well as maybe Fed independence even. We're joined by Bloomberg's chief Wall Street correspondent, Sri Natarajan. Sri, it's going to be exciting. You know, we're always looking forward to big bank earnings, especially when JP Morgan kicks off. What do you expect to hear in terms of, the business lines?
See, what we would have expected, if you were asking me this question last week, would have been the absolute haul that all of these guys have been able to rake in. If you look at their first year under Trump 2.0, it has been extraordinary for the banks, and it's been reflected in their shares. Goldman Sachs up almost 70%, Citigroup up 70%, JP Morgan, Morgan Stanley, all of them up. Even Bank of America, which has not performed great, is up 23% in the stock market. So you would have hoped it's a good news earnings cycles, where they could also talk about the fact that as you see more of this deregulation take hold in Washington and deal-making pick back again, especially with private equity players coming back into the market in numbers, it would be another good year for the banks without them really too worried about a consumer recession just yet. But with that Friday evening Trump tweet, with what we've seen the news coming out of the Federal Reserve, Jay Powell versus Donald Trump as of Sunday night, I think a lot of the questions will be around this. The Fed independence, and the banks really care about that. But more personally and more directly at them is this new populist lean in of Donald Trump, especially as he focuses on the 2026 midterms. When he talks about affordability, you have to remember, whenever there is a wave of populism, banks are never truly spared. With that credit card announcement, the question is it something that was a Friday night tweet and Donald Trump, the president, has already moved on to the next shiny toy, in which case the sector can breathe a sigh of relief? Or if he's actually fixated on it and is serious about it, because even if the 10% interest rate cap is not feasible, they will have to think about offering up some concessions to the big man, because what the president has said has carried a lot more weight than necessarily waiting for legislation in Congress.
I can't even imagine how Jamie Dimon would address this, trying to reassure shareholders, but also not invoke the ire of the president. What would it look like for these big banks, for the credit card companies, to actually impose a 10% cap? Does it just mean they take on less risk, that they don't extend credit to as many people?
Well, both of those things for sure, because just let's look at the numbers. JP Morgan, the second biggest credit card issuer, roughly $200 billion in outstanding credit card loans. They reported an average yield of 9.73%. So a majority of their $25 billion in revenue from their credit card business line is coming from that interest yield. So, and average interest rates across the industry is roughly 22% for those who do carry a credit card balance, unlike Matt Miller. For those who do carry a credit card balance, that's roughly in the 21%, 22% range. So if that would go down to 10%, you can see the numbers at JP Morgan that math doesn't work anymore. How do you do the reward system? How do you make real money out of this business? How do you even factor in the expenses into the business? So that will result in a serious reordering of how they think about the credit card business if, and that is a massive big if, capital I, capital F, if it were to become law.
Okay, I'm assuming voters would be even more angry if the banks turned around and said, we're not going to give you points, we're not going to give you rewards, and that's the net outcome of this.
Right. Well, we're not going to give you credit would be what most consumers hear.
Yeah, but
right?
then they just go to Klarna and Affirm and, buy now, pay later.
I mean, what if your nut is way bigger than what you can do on buy now, pay later, right? I mean, a lot of people are putting real serious charges on credit cards, hopefully not carrying big balances. But I think outstanding credit card balances in this country are approaching $2 trillion. Like, it's a lot. And the average interest rate on that is 20%.
And that is why this is such a big news story, because in some ways these credit card operations, at least for the biggest players, have become the crown jewel. And for those who specifically just focus on credit cards, when you look at names like Capital One and Synchrony, I have to look at what the numbers were this morning after markets open, but at least in pre-market, those two names were getting hammered the most.
By the way, we're just looking at Klarna now falling down 3%. It was rallying quite a bit, so fortune's changing there. Sri, thank you so much for joining. Busy week for you. You're going to join us again for the big bank earnings. That's Bloomberg's Sri Natarajan. Coming up, we're going to take a look at the latest twist in Paramount's pursuit of Warner Brothers with a hostile takeover getting more hostile. This is Open Interest.
This is Bloomberg Open Interest. I'm Matt Miller. Let's get a look at what's going on. What are we, 22 minutes, 23 minutes into the session here. The S&P 500 now a little changed at 6960. So we're only 5.5 points away from the all-time high that we hit on Friday. You know, a lot of talk about, Dani, concerns about Fed independence and worried about what the president is ordering private companies to do or not to do. But we're still at record highs on the S&P 500. We're still close on the NASDAQ right now and only down 0.1%, 25,736. So the gains in stock indexes are real, and that wealth effect has to be pervasive because a lot of people, even if it's just through 401ks, are exposed. Nvidia right now only up 0.2%. I feel like it was up 1.7% when you were looking at the move screen right after the bell. So it's come in a lot. Alphabet shares are down, but only 0.4%. Walmart's still up 2%. Alphabet and Walmart, of course, making that link as Walmart goes to the NASDAQ. It's also putting its products on Google Gemini. Synchrony Financial still down 7%. Worry about credit card issuers, how they're going to deal with this latest edict from the president. Warner Brothers Discovery is off 1.4% as it gets sued by Paramount for disclosure. Paramount currently up about 0.3% as it does not change its offer.
Yeah, more on that, Matt, because as you said, Paramount sued Warner Brothers Discovery, disclose information to help investors make a more informed decision, essentially threatening a proxy fight, saying that they're also going to nominate directors to the board. For more, we're joined by Bloomberg Intelligence media analyst Geetha Raghunathan. Geetha, this seems to have kicked things into high gear. I think it's fair to say that they are threatening a proxy fight. Is that enough to bring Warner Brothers Discovery back to the negotiating table?
Yeah, I'm not so sure, Dani. I think at the end of the day, the Warner Brothers Discovery Board, as well as the shareholders, are really looking for Paramount's guidance to sweeten the offer. So the $30 per share bid, I mean, the reason why Paramount is really standing by its offer is because of this whole controversy around what the stub value of the global networks business is, the TV networks business. So remember, we already have about a $28 per share offer in place from Netflix for the studio assets. The remaining part of the business, which is the TV network business, that is what is causing all of this, controversy and all of this questioning, with Paramount basically arguing that it is worthless. It is worth zero. That's what they said in their letter last week, and which is why they're now suing for additional disclosure. Meanwhile, we know that Warner Brothers board has internally kind of thought of about a $3 to $4 per share value for that TV networks business. And that's really what it's all kind of coming down to. But the last we heard, Dani, is that only about 2% of the Warner Brothers Discovery shares were actually tendered. So definitely shareholders are going to hold out, in my opinion, for a higher offer.
I heard you on, I think, Business Week, kind of giving us the basics, or Carol and Tim, the basics about how much debt Paramount would have to take on, even if it doesn't raise its offer, and what it's going to actually be making in terms of free cash flow. It just doesn't seem to be feasible.
It doesn't. And that has been the whole argument from the WBD board. They called this, in fact, one of the biggest leveraged buyouts in all of M&A, and basically pointing to over $50 billion in debt. I mean, this is for a company that has only about 13 to 14 billion in market cap, comparing that to Netflix, which has about 400 billion in market cap. So really huge difference between the companies there.
Yes.
And then if you kind of look at the pro forma, it's going to be 7 times levered. So that is just massive, Matt.
All right, Geetha Raghunathan there of Bloomberg Intelligence. Really appreciate you jumping on with us. This is Bloomberg. All right, we're 30 minutes into the trading day. Welcome to Bloomberg Open Interest. I'm Matt Miller.
And I'm Dani Berger. For all the Sell America trades, we are basically unchanged on an index, just off the all-time highs reached on Friday.
Yeah, 69.63 and a half, and 69.66 is the all-time high we closed at. Coming up, the Trump administration escalates attacks on the Fed. Chair Jay Powell pushes back hard.
Meanwhile, CEOs remain on guard as President Trump once again rattles stocks, this time targeting credit card companies.
And pharma deals on the rise as the industry shakes off Trump anxiety and gathers in San Francisco for a healthcare conference. We are live with Eli Lilly's CFO later this hour.
And speaking of Eli Lilly, some breaking news just out now. Nvidia announcing plans to invest $1 billion in a new lab with Eli Lilly over 5 years. The idea is to aim the speed of use of AI in the pharmaceutical industry. Eli Lilly shares up 1% on the news. Joining us now is Bloomberg Health reporter Jessica Nix. Jessica, I mean, it's already used quite widely, right? AI in the healthcare industry. So what would this partnership do?
Not as widely as you may think. This partnership is really going to put Eli Lilly at the forefront of using AI in drug discovery, which is something that we haven't really seen before. So they're going to be building this lab out in San Francisco, like Matt mentioned, where we're seeing this big healthcare conference right now as well, and trying to figure out how we can start using AI in that drug discovery process. So they're going to be doing things like automating research tasks and really understanding what they can do better for research and for software.
So it's interesting. There's been so much hope around AI in healthcare. What kind of breakthroughs could they make? What are people talking about in terms of like, pie in the sky treatments that we could get?
Well, I mean, this is a big year for Eli Lilly. They're really talked about because of their blockbuster weight loss shots, which they're going to be launching their oral pill later on this year for that as well. And so that's probably what we're going to be seeing a little bit more of, is how we can kind of use some new medications into new forms, or just develop even more medications and more treatments.
I was hoping you would say cure cancer or Alzheimer's disease.
I think that would honestly be...
I'm not really bullish the pill. Like the pill you're going to have to take on an everyday basis, right? And you won't be able to like drink water or eat food within 30 minutes of that. And why is that better than a shot you don't feel that you do once a week? I don't get that.
Some people just really have shot anxiety too. And the pill's really going to be used to be able to make sure that people can maintain when they're off the shot. But you're right, this could be a really great breakthrough for cancer treatments in the future.
Is this going to be a race, though, like not just to develop obesity medications, but now a race of who can partner up with Nvidia, who can get what access to what AI thing, who has the money to invest in this? Is this the like new 2026 trend we're going to have to witness?
I think this is something to definitely watch. Just last week, we saw that OpenAI launched ChatGPT Health, where you can upload your medical records to the chatbot. Now Anthropic is trying to get in on that too by launching something similar with Claude. So we are seeing this partnership between tech companies and big pharma companies.
Claude is my favorite chatbot name.
Not Manus? That's a good one.
I haven't used Manus, but Claude. Jessica, thank you very much for joining us. Jessica Nix there, Bloomberg's healthcare reporter. Stay tuned for our interview with Eli Lilly, CFO, at the JP Morgan Healthcare Conference later this hour. As Jessica points out, that's where they'll be putting this facility as well. So a lot going on in San Fran. Meanwhile, in Washington, D.C., Fed Chair Jerome Powell releasing a statement after being served grand jury subpoenas from the Department of Justice. Powell calls the move political.
No one, certainly not the chair of the Federal Reserve, is above the law. But this unprecedented action should be seen in the broader context of the administration's threats and ongoing pressure. The threat of criminal charges is a consequence of the Federal Reserve setting interest rates based on our best assessment of what will serve the public, rather than following the preferences of the president.
Joining us now with more is Michael McKee, Bloomberg's international economics and policy correspondent. And Mike, you've been covering the Fed for as long as I've been here, which is a long time. And Powell, obviously, closely the whole time he's been in that position. How different is this response from what we've heard from him, over the last, 8 years of Trump?
Basically, this is unprecedented. No Fed chair has really come out and criticized the president and the administration in this way. In general, the response has always been to criticism that we put our head down. We're just doing our job. We're going to stick to our knitting, all of that. And that's the way Powell has been through Trump's first term and through the second term so far, whenever the president has criticized him. Now, the question is this at the direction of the president, or is it some of his lower-ranking officials. Bill Pulte, the head of FHFA, has gotten some of the blame for this. He did fly down to Mar-a-Lago with Trump last weekend. The president telling NBC last night that he doesn't know anything about it. He went on to criticize Powell again. But then Pulte this morning on Bloomberg Surveillance said, I don't know anything about it, and I would refer you to the DOJ. Now,
no one knows anything.
We don't know anything at this point. We're looking to see what the criminal subpoenas actually are looking for, but probably something, the notes or something that Powell worked on when he was going to testify to Congress, because they're the ones who said that's the venue in which they are charging, or at least arguing, that he may have lied to Congress.
By the way, doesn't Congress deal with it when you lie to Congress? Aren't they the ones who bring you to justice for that?
Unprecedented. There is no more Congress in terms of basically governing the country lately. It's
but
all
some of
been
them are
the
saying
president.
that they're going to push back on nominations.
That's the interesting point, is Tom Tillis he's retiring, so he doesn't have to worry about Trump threats, but he's the senior Republican on the committee, and he says that he is going to not vote for anyone as chair, the replacement chair, until this is cleared up.
And that he's enough to hold it up.
He's
right?
enough to hold it up because it's a 13-11 split in terms of the partisan Republican Democrats on the committee. And so lose one Republican and you can't get anybody through committee. There's other ways they could try to advance a nomination. It's going to make it very difficult. And the other issue is that anybody who is chosen by the president now under these circumstances is going to get a lot of suspicion on Wall Street and at the Fed as being just a tool of the president's ambition. And so you wonder how this happened, because it doesn't seem to be in the president's best interest at this point.
Yeah, actually, Rebecca Patterson was saying exactly the same thing with us just moments ago. Mike, great having you here with us on set. Michael McKee is our international economics and policy correspondent. Let's get right now to Jack Janasiewicz, portfolio manager, lead portfolio strategist, I should say, at Natixis Investment Managers Solutions. And Jack, you know, it's interesting, as I saw, well, first on Friday when I saw the credit card interest rate cap, I thought this is going to be very difficult for markets to process. And then when I saw the DOJ investigation into Jerome Powell and the Fed, I figured the bond vigilantes would come rushing back. But we don't really see any bad trades in size, right? I mean, markets are unchanged and the 10-year yield's only up to like 420, a little under it.
Yeah, I think when we step back and look at the abilities for some of this stuff to be enforced, right, a lot of this really can't be done via executive order. It does need to get through Congress. So I think that's one thing that markets have looked at. The second one, I think we've grown somewhat accustomed, unfortunately, to these threats and then sort of Trump backing down. And you guys have made reference to the taco trade earlier today, and I think that's partly what we've sort of become accustomed to.
On that, Jack, I was struck by what Peter Shearer wrote this morning of Academy Securities, saying that midterm elections are driving everything. Expect a lot more announcements on subjects than you thought were possible, even in your wildest imagination. Jack, I think some people are starting to come to grips with that announcements capping credit cards, forcing companies to invest in Venezuela, they're happening, and they weren't expected. Given the surprising nature of some of these, does it change how you should think about a portfolio in 2026 heading into the midterms?
You know, I think it's tough really to do a ton of things in here in front of that, just simply because you just don't know how this is going to play itself out. Now, I know, as I just mentioned, some of this needs to be done through Congress. I think there's also ways that maybe he could sort of threaten, coerce some of these actions to get done at the margin, and maybe in less impactful ways, but at least getting something done. But if anything, maybe the risk is to the upside in here, because this could actually end up being pro-growth. And so that is one of the things that we're thinking about as we head into the 2026 midterms. Maybe the risk to our outlook is that things actually come in a little bit better, simply because that midterm outlook becomes very front and center in trying to pull up those pollings.
Are you worried about the 10-year yield rising from here? I mean, as we said, 420, or right now we're at 419. It's not very high, but it still is like 60 basis points higher than it was when the Fed started cutting rates, right? And I know that we're at 375 now. The terminal rate is priced in by markets at just over 3. Does that mean can we pull the 10-year down with those cuts, or does it continue to move in the opposite direction?
I think we're still going to see somewhat of a range-bound Treasury in here, and our outlook looks at maybe plus or minus 25 basis points from given levels here, because you have somewhat of a tug of war, right? And I think when we start to look at the longer-term inflation outlook, and I think that's really key to what drives the bond market here. It's that growth and inflation backdrop. What's more likely, inflation continuing to sort of head down towards 2% and the unemployment rate drifting higher, or just the opposite? And I think that's the case that we're looking at. The odds of a slowing labor market and probably a continued downward push in inflation, largely as a result of that shelter component. That probably puts inflation on the downside, and I think that's what the market will end up looking at, and that should keep the at least the lid covered in terms of a potential move higher in the 10-year.
Just given that, I would love to get your take on JP Morgan just out with a new call on what they see for rate cuts this and next year. JP Morgan now, led by the team with Michael Ferroli, no longer sees cuts on the table for 2026. In fact, Jack, they think the next move from this Fed will be a hike in 2027, given the labor market looks stronger and a Fed that is preoccupied with whatever will happen with the Fed chair. I wonder what you make of that idea. No cuts this year and instead a hike next.
Yeah, I think a lot of the optimism that we continue to see when we read some of the stuff that's put out from our competitors really revolves around, the one big beautiful bill finally working its way through to the consumer. And the one thing I think that we're a little bit more concerned about is that typical multiplier effect, as you get a dollar back, roughly 50 cents of that dollar ends up getting spent. That suddenly becomes not quite as large of a number when you look at it relative to the overall backdrop. If you've got $100 billion getting kicked back to the consumer, which is what we're seeing for estimates for tax refunds, half of that is spent, so $50 billion. You're looking at personal consumption expenditures around $22 trillion. You do the math there, and you're probably talking about 25 basis points worth of a bump. Not nothing, but I don't think it's enough to see a massive impulse here for the economy. So, we're somewhat optimistic with growth, but I don't think the reacceleration that many are penciling in here, I'm not sure it's quite as strong. And as a result, we're still thinking the odds of a rate cut are probably still higher than increases in rates going forward between now and the end of the year.
But maybe a steepening yield curve still, as Rebecca Patterson was suggesting earlier. That would normally be good news for the financials, and you like them. They've done incredibly well so far, looking at 2025. Does that continue as the president kind of pulls these populist moves and says, we're going to cap credit card interest rates at 10% for a year?
Yeah, I think that's probably continues to be the trade in here, right? I don't think you're going to see a ton of parallel shifting going on with the curve.
So you don't take that threat seriously, essentially, Jack?
Yeah, I think it ends up working its way through when we sort of look at it as a knee-jerk reaction. So the Treasury market, I think all the action will be in the steepener.
Yeah, and again, it's what we're definitely seeing today. 30-year yields up 3 basis points. Jack, thanks for joining us. Jack Janasiewicz of Natixis Investment Manager Solutions. A check on your markets this morning. The drama may be there in the bond market. 10-year yields up by 2 basis points. I should point out, though, that is the highest in only about a week. So, yes, the move is up, but the magnitude isn't crazy. U.S. stocks off this morning by 0.1% for both the S&P and NASDAQ. But, Matt, it is off of all-time highs. So those are still some punchy levels.
All right, coming up, more on the fight between the Fed and the White House. We'll get the details on the DOJ probe into Jerome Powell. This is Bloomberg Open Interest. Let's get to high interest now. Look at what's making headlines around the world. Iran's foreign minister says security forces have full control of the country after 2 weeks of violent unrest. Protests erupted on December 28th after a sudden collapse in the value of the currency. And according to the human rights activist news agency, more than 540 people have been killed. Over 10,000 people have been arrested in Iran. Paramount Skydance says it plans to nominate directors to Warner Brothers Discovery's board to vote against the approval of a merger with Netflix. Really, a sale would be a sale to Netflix. Paramount filed a suit to force Warner Brothers to disclose information to help shareholders make an informed decision. So I'm trying to get more disclosure from Warner Brothers Discovery. And President Trump reiterates his call for credit card companies to cap interest rates at 10% for a year, saying lenders will be in violation of the law if they don't comply by January 20th. It's not clear what law he meant. Maybe he's implying that he will sign before then some kind of executive order. But right now you see shares of credit card companies down really across the board, with Capital One falling the most at 7.6%. And that is just one story that we're following out of the White House. It's been a whirlwind week. The Fed has been served grand jury subpoenas from the Justice Department. For more on the impact, we welcome Ira Jersey, Chief U.S. Rate Strategist at Bloomberg Intelligence. And Ira, I'm wondering if this is all part of President Trump's plan to bring rates down on the long end, because it seems to be pushing them up, at least today.
Yeah, I don't think that the president, if his goal is to get long-term interest rates down, reducing the Fed's independence from the executive is really the way to do it. Because every time that we've seen threats from the president to the Fed's independence, you've seen steepening of the yield curve, and certainly long end selling off. Because basically the market's going to be pricing for higher inflation going forward, because if the Federal Reserve is going to keep monetary policy easier than it should be for any given economic environment, then that should mean on average inflation should be higher, and the market is certainly reacting to that possibility.
Ira, is there a possibility, though, that this actually has the opposite effect, that it causes a Powell and maybe the rest of the FOMC to dig in their heels, and you get a scenario where Powell stays on and maybe assumes more of a leadership position in 2026 and challenges a Trump-appointed Fed chair? Couldn't that have the opposite effect of ensuring that a Fed doesn't kowtow to the president?
I'm sure that's possible. You know, the members of the FOMC that I've met and that I've interacted with are all very strong public servants who take their jobs very seriously and are independent. You know, so I think that most of them will still continue to do what they think is best for the economy and to fulfill their dual mandate, right, for full employment and stable prices. So in that situation, if Jay Powell were to stay on, right, it creates a weird dynamic between whatever new people are coming in that President Trump appoints, plus Chair Powell as Governor Powell would certainly have a say and a sway on some members of the committee. I think it creates a really awkward dynamic, and I am concerned, about what this means for how we analyze where monetary policy is going to be going forward. I think one way or the other, the thing that's been slowly building throughout the last, I would say half dozen years or so, is we're probably going to get more regular dissents from people who have widely diverse views, right? And we know members of the Fed right now, in particular, do have widely diverse views.
I keep bringing up the long end rates, or the 10-year rate at 4.20 right now. We're like 60 basis points higher than we were, or 70 basis points higher than we were when the Fed started this cutting cycle in September of 2024. Why hasn't the 10-year tracked the front end? Is it political? Is it financial? What's happening that the 10-year yield rises as the Fed cuts rates?
Well, it's not really, right? Because what happened was, remember, in 2024, it was all about how deep the Fed was going to cut interest rates first, and the pace of those cuts versus reality, right? So, and remember that the yield curve being upward sloping like it is now, the yield curve 75-ish basis points between the 2-year and the 10-year, that's not unusual. In fact, if you go back and you look at the last 50 years of history of that yield curve, actually 75 basis points on the lower end of how steep that curve typically gets. So it's not unusual, because look, the market is still saying that the Federal Reserve, if they cut interest rates down to where the market is currently priced, that means that you have a slightly wider yield curve, a steeper yield curve. But in the future, we think that the Federal Reserve is going to hike interest rates because the economy is going to be good, inflation might be a little bit too high, and that's the reason why you have an upward sloping yield curve typically. And so this is just a normalization of things. Look, we spent the longest period in our history with an inverted yield curve, so we just have to get used to the fact that we're going to have this upward sloping yield curve. It's just a matter of, is it because 2-year yields go down to 2%, or is it because 10-year yields go back up to 4.5% or 5%?
Yeah, at the moment, 10-year yields leading that. Ira, thank you so much for joining us. Ira Jersey of Bloomberg Intelligence. Still ahead, Eli Lilly, CFO, joins us from the JP Morgan Healthcare Conference following Nvidia's announcement of a joint investment into the company. Stick around with us for that. This is Bloomberg.
Taking a look at the stock market right now, we are pretty much unchanged from the high levels that we closed at on Friday. This is the move screen on the S&P 500. You can see that we've lost about 5 points here at 69, 61, 69, 62. So very close to Friday's close. Helping us stay abreast of further losses. You see Google adding more than 1% here. Broadcom is a gainer. Tesla is a gainer. Walmart, because of its partnership with Google and its move to the NASDAQ, moving higher right now. In terms of the losers, it's pretty clear that the banks are, and especially the credit card issuing banks, holding us down. JP Morgan Chase, Visa, MasterCard, Capital One, American Express, Citigroup, all on the downside, along with Facebook. Taking a look at what's going on with the industry group breakdown, you can see exactly the same thing. I mean, right down here, S&P 500 Financials Index, the biggest loser, off more than 1%. And then most of the other groups are gaining today, with consumer staples up more than 1%, materials, comm services, those are the hyperscalers, and utilities leading the way. Coming up, economist Kathy Bostjancic weighs in on President Trump's credit card threat, as well as his fight with the Fed. This is Bloomberg Open Interest.
Credit card companies are tumbling in today's trade. President Trump saying that the lenders would be in violation of the law if they don't cap interest rates at 10% for 1 year. Klarna's CEO said the credit card system is unfair to low-income households and welcomed the changes. Those shares were higher. Now they're lower, more than 4%. Kathy Bostjancic, chief economist at Nationwide Mutual Insurance, joins us now. Kathy, I guess two things to address to this: whether a rule like this could even be likely or lawful, and two, what impact it would have. Let's start with the first. What is the likelihood that the president would actually be able to cap credit card companies' interest rates at 10%?
Well, good morning, Dani. Happy to be with you. Yeah, it's unclear. I mean, the legal experts and just the law suggest that this would likely need congressional approval. So it's not seen as something that unilaterally the president can impose. So we'll have to see how that plays out. And those analysts really kind of in that sphere, suggest that there's pretty low odds at this point that Congress would approve, such a 10% cap. But certainly could still put pressure in the meantime on the banks and the credit card companies.
Yeah, I mean, it's not stopped him before, right? Maybe he could use IEPA to do this. I wonder what it would do, if this were the case and banks thought they had to follow these rules. What would that do to credit card users? Because we're looking at, I think, $1.25 trillion worth of outstanding credit card debt, and very few of us have interest rates even approaching 10% on balances held. They're more like 20% on average. So how would that shake out, Kathy?
Yeah, I mean, there's a number of factors to consider, right? As if this play out, one, it certainly could reduce interest costs for certain households quite dramatically, right? As you said, going from somewhere 20% or north of 20% to 10%. And then the question is, does it apply to back balances, balances outstanding, or just new credit charges? But I think we also have to consider, what, these banks or the credit card companies would do in terms of the availability of credit, right? So they would argue that credit card rates are high because you need to take into consideration defaults or delinquencies and a range of credit scores, right, that's available, to receive credit. So if they are forced to lower the interest costs that they're charging, then they could reduce the amount of credit availability, especially for lower income and lower, FICO scored consumers. So, and it could force those consumers more into the alternative markets if they're really determined to get credit, which could, is less regulated and ultimately could even be more expensive.
Kathy, just taken as a whole, all these announcements we're getting heading into the midterms, attacks on the Fed independence in an attempt to lower rates. Again, these are things I guess we got before the midterms, but things like the One Big Beautiful Bill, giving checks to people, capping credit card interest rates, not allowing private investors to invest in housing. This big affordability push, the fire hose of information we're getting out of Washington, D.C., just taken as a whole, how are you thinking about the effects on this economy?
Yeah, so great question. We're looking at all of these and trying to factor those in. But, I think just taking a step back, like fundamentally, the economy is doing quite well. And I think it's actually surprised many people, especially given all of the policy changes for last year. And corporate earnings have been really strong. That's why the equity market has done so well. And economic growth, like for the fourth quarter, even though the government shut down, it now looks like economic growth could be 3% or higher. So we're coming off a pretty strong economy as we headed into 2026. Then, as you said, the One Big Beautiful Bill, well, that actually adds fiscal stimulus. So we estimate it adds about 0.4 to GDP growth. Then you've got the Fed has lowered interest rates. That adds some monetary policy stimulus. And I would say the One Big Beautiful Bill does help some of those lower income households, right? So you've got no tax on tips and overtime and things like that, Social Security. But, we'll have to see the totality of how this plays out. I think, certainly I think one thing the markets will be very sensitive to is, among all the populist actions is really, the independence of the Fed. I think that is key. We'll see how that plays out. There are some mechanisms in place, right? Senator Tillis said that he would maybe hold up a confirmation of Trump appointees or nominees for Fed chair. And at the end of the day, the bond vigilantes vote on long-term interest rates, not the Federal Reserve.
Yeah, I think the Tillis news is kind of underpriced right now. Or maybe not. JP Morgan says it no longer expects a Fed rate cut. In fact, they predict the next move will be to the upside, a hike in 2027. And Kathy, doesn't that make sense? I mean, with the economy growing so quickly, getting some stimulus in from this big, beautiful bill, stock market at an all-time high, unemployment at 4.4%. Like, how does anybody see rates as restrictive with all of these data points?
Well, I think to us, what the key is inflation, right? So we think that inflation peaks early Q2, and actually the Fed's revised forecast came in line with their own forecast. And then as it trends lower, I think it does give the Fed room to cut interest rates.
But do you only cut when you have room, Kathy? I mean, why not keep that powder dry, especially if the economy is doing so well, everybody has a job, and we're all making money from the stock market?
Well, I do think that rates are a little bit restrictive right now, not massively. So we look for 50 basis points of rate cuts. And I would say that while the overall economy is doing well, the equity market's doing well, consumers are spending, what we see is the labor market has been lagging. And that's not new. That's been since the middle part of 2023. So I do think it makes sense to help out labor market, provide some support, just get back to neutral. I'm not saying become accommodative. And while financial conditions are easy now, that could change. And we also know conditions for consumers, some consumers are facing strain. I'd like to see auto loan rates come lower. Also like to see mortgage rates come lower. Imagine if we got the interest rate sensitive sectors of the economy, autos and housing booming, that would be a really strong economy. Then maybe would be more inclined to think the Fed can't cut rates, but I don't really see that for now.
All right. Will be interesting to see. I mean, especially with so many people defaulting on auto loans and auto prices at such a high level. I don't know how much difference it would make to see these rates come down, right? Because it's already a fairly unaffordable product for most of the nation.
Well, I think lower rates help, right? Certainly they help. And I, on the margin that goes a long way. I do agree that, the run up in inflation that we've seen in the last few years has been punishing for certain households. But, here's the key. If you start to see labor market firm, which I see some signs of that, right? Since the summer, private payrolls have kind of firmed. Now it's far from a booming labor market, no doubt. But if you start to see a stronger labor market, you see a little bit of healthy wage growth, that really goes a long way to help households. And lower interest rates a little bit on the margin certainly can help.
Kathy, great having some time with you. Really appreciate you joining us. Kathy Bostjancic there of Nationwide Mutual Insurance. Get a check now on the markets right now. Really little change. We're at essentially 69.60 and we closed at 69.66 on Friday. The NASDAQ down a little more, almost 0.2%, but 25,722, getting back closer to those October highs. The 10-year yield at 4.18.5. Really not jumping to levels that are at all eye-opening. So, yeah, there's not a lot going on at the index level. There's a lot of movers under the hood.
Yeah. So some of the movers that we are looking at, we're watching shares of Alphabet and Apple. Apple has reportedly entered a multi-year partnership with Google's Gemini to run its AI-powered Siri later this year. What will the price tag be? Mark Gurman had reported earlier, just about 2 months ago, that they would pay $1 billion a year for this, which seems kind of cheap considering other tech giants have spent hundreds of billions a year.
Billions nothing these days.
Yeah. What is a billion?
You gotta hold up your little finger to your mouth, one like Dr. Evil
yes,
there.
Yes, exactly.
Walmart is set to replace AstraZeneca on the NASDAQ 100. It has inked a deal with Alphabet to integrate Google's Gemini, and everyone's getting with Google's Gemini, right?
It is the truth.
Apple as well. Porsche, by the way, Porsche shares are getting crushed today, down another 6%. Okay, they trade in Germany. The ticker is P911, which I think I probably would have gone with a different ticker, but that's what they chose when they IPO'd. And who would have thought that these shares from the IPO would lose 45% of their value? It's like the biggest loser of all automakers on the face of the planet since they IPO'd. Nobody has done this badly.
Why have they done so badly?
I guess because they've poured so much money into EVs. Some of them, by the way, are brilliant. The Taycan, the new GTS I drove, amazing vehicle, but it's priced the same as a 911. And if you're going to pay that much money anyway, you might as well buy a 911.
Fair enough. It'd be surprising to a lot of people considering luxury has done well elsewhere. Coming up, Nvidia teams up with Eli Lilly to invest $1 billion in a new AI lab. Man, lots of AI agreements this morning. Eli Lilly CFO is going to be joining Katie Greifeld from the JP Morgan Healthcare Conference. We're bringing that conversation next. Nvidia has announced that it will team up with Eli Lilly to invest $1 billion in a new lab in Silicon Valley, aiming to speed up the use of AI in the pharma industry. Joining us is Bloomberg's Katie Greifeld from the JP Morgan Healthcare Conference in San Francisco, along Eli Lilly's CFO. Katie, take it away.
Thank you, Dani. I am sitting here with Lucas Montarce. He is the CFO over at Eli Lilly. First off, it's great to see you, Lucas.
Thank you for having me.
So we have to talk about what you're doing with Nvidia, but we have to start first with what's going on with pills, obesity, weight loss pills. So Novo Nordisk, the big news at the end of last year was that they won approval for their obesity pill. You think about Eli Lilly's own obesity pill. Are you still on track potentially for that March approval?
Yes, we are on track. We submitted for regulatory approval, actually, and we are expecting that to take place as early as Q2 this year.
And given that Novo has a couple months on you there, how does that affect your strategy to launch this pill? Will it be available on all telehealth platforms to start?
Well, when think about the space, bringing the orals is actually going to expand the market from our perspective. And remember that we are talking about 100 million patients that we can serve here in the U.S., and there is more than 900 million patients OUS as well. So when you think about this, it's not a matter of a timing of a few months difference between one company and the other one, but more thinking about how many patients both companies can serve with these pills as well.
Well, you touched on something that I've been wondering about when it comes to the introduction of obesity pills, how that will sort of shape the market for obesity drugs going forward. Do you see it basically expanding the total addressable market, or do you think to some extent that the introduction of pills will sort of cannibalize the injectables?
Certainly, when you think about nowadays, we are serving low single-digit number of patients globally. And there is plenty of feedback from physicians and also patients that, again, there is a preference as well for orals, that there are certain patients that they are not willing to go to the injectable. So this will expand, in my eyes, both in the U.S. and OUS, the market.
And we have to talk a little bit about pricing, too, because in November, you struck a deal with the Trump administration to lower prices when it comes to weight loss drugs. And your deal was specific to this KwikPen device, which is not yet approved for Zepbound. So when are you expecting to see approval there?
We are expecting to see that approval taking place within the next few months. So we are excited opportunity to bring the KwikPen as well to the market. Remember that we have what we call the injectable for the commercial business. We have as well the vials for what we call direct to patients, the Lilly Direct platform. By the way, the Lilly Direct platform is serving nowadays more than 1 million patients. So has been growing extensively. And now again, the KwikPen will also bring another option to the patients as well.
And now I have the impossible question to ask you that now that it seems like most pharma companies have signed deals with the Trump administration, are there any other initiatives or, sort of left field policy decisions that you think could come from the Trump administration?
I think this agenda, when we think about 2025 and what we call the most favorable nation, this is almost settled and done at this time. I think most of the companies, including back in December, have signed their agreements. So hopefully this will provide some more stability and transparency here in the marketplace getting into 2026 as well. But more exciting opportunity as well, in particular for us, is the opportunity to get access in the Medicare space for patients on these anti-obesity medications, both tirzepatide and orforglipron, could get access on these ones, and the patients will pay as little as $50. That could happen as early as April, but no later than July. So that is an exciting opportunity as well to continue to drive growth and have served more patients as well here in the U.S.
Absolutely. Between the introduction of obesity pills and, of course, the Medicare factor as well, it's going to be an exciting year for the obesity market. But let's go beyond obesity because we have to talk about M&A. Actually, at this conference last year, Eli Lilly announced a deal with cancer biotech Scorpion. You think about just last week, you guys announced a deal with Ventex that specializes in developing drugs to treat inflammatory diseases. How are you feeling about the portfolio right now? Are you done for the time being, or do you see opportunity for more M&A to expand from here?
Yeah, very exciting opportunity. You mentioned two of them, but we signed actually more than 30 deals last year. As you know, our target has been always going early phase. Again, that's actually what brings value to our portfolio across all our therapeutic areas. You mentioned Scorpion, very exciting opportunity in the oncology space, and it's actually now advancing into phase 3. And you mentioned Ventex as well in the inflammatory diseases as well. I think that will actually serve us as a platform across not only cardiovascular, but also neurodegeneration and also immunology as well. Thinking about the future, we continue to expand into basically these core therapeutic areas, but we are looking as well at emerging therapeutic areas as well, and also what we think about platforms and bringing the right also expertise as well. That's part of our secret sauce thinking about the M&A space that will expand our internal pipeline as well.
And so to that point, I mean, when it comes to obesity and diabetes, it feels like the market hangs on every update. But when it comes beyond those key areas, I mean, what catalyst should investors be looking out for this year?
Yeah, across all the other three therapeutic areas, oncology, we have plenty of data readouts. Actually, last year, we have every single quarter, we have data readouts in oncology. This year will be very similar. We have more data readouts in pirtobrutinib, in CLL, and we have olomorasib potentially having data readouts. It's an event-driven study, but could also have the readouts later this year, getting into 2027. So oncology is an exciting space. Neurodegeneration, again, we have our Alzheimer portfolio there, and we have a pipeline of products in that space. Last but not least, as well in immunology, we launched in atopic dermatitis Ebglyss, and we are bringing, again, with these deals, new opportunities into the future.
And I am curious, you've said that you will reinvest your earnings, and just given the speed at which Eli Lilly is growing, what should we expect when it comes to profitability, when it comes to operating margins? Are there any specific levels that you're targeting?
We are not targeting levels, but we are thinking about how we can drive sustainable growth over time. We are building the pipeline. As I said, we have the largest pipeline in our entire history now, and we feel that we can continue to build in that pipeline to drive sustainable growth over time is the focus and priority for the organization. So we will put that capital to work to make sure that we drive that sustainable growth over time.
And let's get to the fun stuff. The headline this morning that Nvidia will invest $1 billion over 5 years to build a new lab with you in Silicon Valley. This follows, of course, on news from October that you're partnering with Nvidia to develop an AI supercomputer. Just walk us through the vision here, what this means for Eli Lilly and potentially for the healthcare industry. Should we see some of these efforts really start to bear fruit?
Yes, for sure. And the other event I think is worth to highlight, we hire our Chief AI Officer back in 2024. So it's building actually a strong momentum into what we think that is one of the largest opportunities on how we can leverage AI, in particular in drug discovery, that to actually go after the hardest opportunities that we have in that space, how we can transform that, accelerate, and augment the work of our scientists. This new collaboration that we signed today is an investment up to $1 billion, over 5 years that we are going to be doing with Nvidia, and we are going to put both scientists and engineers of both companies to work on this over the near future. So exciting opportunity ahead.
All right, well, look forward to keeping in touch, especially on that topic. Lucas, great to get some time with you.
Thank you for having me.
Back to you guys in New York.
Thank you very much, Katie Greifeld. Katie sitting down there with Eli Lilly's CFO. Stay tuned, by the way, for Katie's other interviews at the JP Morgan Healthcare Conference throughout the day. They include Pfizer's CEO at 2 p.m. New York time. This is Bloomberg Open Interest.
Breaking news we got earlier this hour, Apple has reportedly entered a multi-year partnership with Google's Gemini to run its AI-powered Siri later this year. Mandeep Singh, global head of tech research at Bloomberg Intelligence, joins us now. Mandeep, Mark Gurman was also reporting that this was in the works. He was talking about this about 2 months ago, saying that the price tag would be $1 billion a year. That seems incredibly cheap considering all the other big tech giants are spending hundreds of billions of dollars a year on their AI.
Yeah, and it's not a surprise because Google obviously comes with TPUs. They already have their existing search relationship with Apple. And look, at the CES, Amazon launched Alexa Plus. So you know there's a lot going on with agentic commerce and voice, and Apple has to obviously step up in terms of whichever LLM they want to use. And to my mind, Google is the most obvious choice. And there is no shortage of functionality because we know everyone is looking at voice as an area for agentic commerce. So this is coming in at a good time.
I was looking at, not Google, at our own WSL Predict, which is something that Michael McDonough puts together for the Bloomberg terminal. And one of the things you can bet on is who has the best AI at the end of the year, and Google dominates 91% over XIA. OpenAI only has 0.9%. Sorry, this is for the end of January. Are they really that much ahead?
Well, I would say all these frontier LLMs are closed, and now the trend is more towards specialization. What Anthropic has shown is you can focus on a particular area and really improve the model to the point that you can gain a lead. So that's where I think OpenAI will do well, as will Gemini, Grok, and all these frontier models. In fact, Meta has talked about voice as a use case where they really want to hone in their model for voice because they feel it's going to work very well with their glasses. So I do think all these models will continue to pick a use case and get better.
All right, Mandeep, glad we could get you in the program today. Mandeep Singh there at Bloomberg Intelligence runs tech coverage for us. That's it for Bloomberg Open Interest. Stay tuned.